Hey, welcome to the Exchange. This video is on the combination of Zynga Games with Take-Two Interactive, kind of see what's the dual valuation of those companies together, also where they can go in the future to really affect the gaming industry as a whole. So this is a spreadsheet I built, just kind of give you an idea of how much actual revenue they bring in each individually. So this is 2021 and 2022 revenue. Looking at the top line of Take-Two Interactive, the bottom line is Zynga. I mean, Take-Two is bigger than Zynga, but not by much. I mean, Take-Two is a much more established brand, I would say, but Zynga has basically a broader appeal across these mobile gaming platforms. So let's take a look at what they actually own. This is Take-Two Interactive. This is from their investor presentation. So they actually own Rockstar, basically the games developer studio. They own the 2K brand, the private division, and T2 mobile games. So predominantly, they're kind of, you think about them as a console and a PC kind of basically powerhouse. They do have mobile gaming that kind of arms off that though too, but predominantly they're kind of your legacy PC mobile gaming platforms. Look at the actual logos themselves. I mean, the biggest one obviously is Grand Theft Auto right there. Also the 2K Sports Series across the board. They own Red Dead, they have Borderlands, look at Bioshock, and these are all prime, AAA title kind of games out there. Some of the mobile games they do have, some of them you wouldn't recognize, but they are out there. But again, it's a major brand. This is like a kind of your AAA title kind of developer house or conglomerate, and they're very well established and they're very successful overall. So this is Zenga Gaming. This is straight off their website. It's a lot of these basically matching games or like solitaire. It's the games that you'd see on like the iPhone store that'd be very high up there, but you may or may not play them. Now here's the thing about these games: they are cheap to make overall. They're actually they're just basically gaming, mobile gaming, casual games where it's like, hey, your grandma can pick these games up and play and kind of figure it out. So the actual broadness of the appeal there is much wider than like Take-Two Interactive's overall platform, which is a lot more kind of narrow in the console and PC kind of world overall. But again, these are great games. I mean, the problem is though too is even though they're easy to develop though too, is like barriers to entry are pretty low on these games. Also too, competitive pressures are out there on some of these platforms. Also, the actual like how long they're popular for could be much shorter than Take-Two Interactive's overall games. So here's like a buying cost of revenues. I broke that down here, but more importantly, look at the actual gross margin percentage by studio. So Take-Two profit percentage is 54%, 56%. Zynga is actually 64% and 63%. You gotta remember too, mobile gaming is growing faster than console and PC gaming. So basically, I mean, even though Zynga it's more competitive overall in the mobile gaming kind of space, I mean, they are much higher profit margins. They have a faster growth rate, which really is why Take-Two wanted to acquire them. Because console PC gaming, I believe it's like growing at 6% year over year. It's not a fast growth rate. Whereas mobile gaming, it's 10% plus. I mean, it's a much faster growth rate overall too. So even though it's like dumber games or cheaper games to make, I mean, it's basically a faster growing platform and overall higher grossing, basically higher gross margin percentage overall too, which makes sense. But it's really what Take-Two Interactive kind of lacked, kind of in their internal development house they already had. That's really why they acquired Zynga at I would say a decently high premium for the actual acquisition price itself. But we'll see. It might pay off. Might be a great acquisition in the future. 3 to 5 years down the road. So I just want to caveat off that. So this is actually from Take-Two Interactive's investor presentation. So they're saying there's 3 billion global video game players in 2021. Now, the vast majority of these are actually mobile gamers. I want to say PC console gamers are only like 5 to 800 million. It's not that many overall. So the much bigger slice of the pie actually is the mobile gaming platform. And that's why Zynga acquisition for them made a lot of sense. But again, we'll see if it pays off or not based on the actual financials, etc. But I mean, for total addressable market value itself, it is definitely there. The market value is definitely there for the long-term kind of value of Zynga and Take-Two combined. So looking at gross profit by year, I mean, this is a very, on gross profit basis, a very profitable industry. I mean, it makes a lot of money, turns out a lot of money. It is a very OpEx heavy, basically industry as a whole too. So looking at sales and marketing here, this is all combined between Zynga and Take-Two Interactive. I mean, it's a very sales and marketing heavy industry as well too. Basically getting your apps, added, make sure they're high in the app store, kind of like the download charts, etc. R&D is basically your R&D pipeline for future game development. So it's kind of weird where you basically invest dollars today, but you won't see the payoffs for 2, 3, 4 years down the road. Especially for Take-Two Interactive too, like Grand Theft Auto, for example. I mean, it takes multi-years of actually investment in R&D to actually research and create these games for actually launch years down the road though too. So it's a little bit offset R&D versus the actual realization of the actual return on the investment right there. G&A, again, it's not that much here. I mean, overall staffing levels and everything else too, kind of front office staff, it's not going to change that much. And this should kind of maintain a somewhat flat rate, basic accordance with revenue. Business reorg, I assume 0 reorgs from now on until 2027, which is it's just an assumption right there. But look at the totals down here. And really, what I did is percent of revenue totals. I mean, 2022 and 2023, they should be pretty maxed out as they kind of combine these initial businesses together themselves. But as they grow together, basically, they should have synergy of, basically effects. It should drop the actual OPEX basically as a percent of revenue. It should come down in the future, hopefully. As you see here, it's 54%. I mean, down to what I'm saying, 2027, 46%. So basically, as this drops down, the margin itself should expand overall for the actual entire company as a whole combined. So I want to show you this as well too. This is from their business combination, kind of like announcement. So basically, they acquired Zynga to diversify the company's mobile offerings further, enhance its position as a global leader in interactive entertainment. So obviously, they had a weaker kind of mobile gaming platform, even though it's a bigger audience overall, which is why they acquired Zynga. But what's interesting down here is actually from the CEO's comments, and the biggest thing to look at is down here. So basically, what he's saying is including $100 million of annual cost synergy. So basically, the OPEX expenses should come down combined $100 together versus individually apart. They're also including here at least $500 million of annual net booking opportunities over time, which means the top line revenue combined should increase $500 million combined versus separated. That basically wouldn't happen. Again, we'll see if it's going to happen though, but going back to the actual model real fast. So basically, if you imagine $500 million here, it's basically a 10%, a little 8% revenue gain, which again is fantastic. $100 million in OPEX, looking at 2023, 2024, I mean, these are massive OPEX numbers, looking like 3.5 billion, 3.8 billion. I mean, it's not that much, a couple percentage points right there, but again, anything helps here too, because if you can drop OPEX at all while maintaining a strong revenue base, you're going to have margin expansion, which equals a lot of profit. So going back to the model real fast, so I mean, look at interest here. They're going to actually take on more debt basically to acquire Zynga itself. So this interest payments will go up dramatically. I mean, it won't be out of control, but it will be a strong increase. I assume long-term investments is just flatline at this point. That's probably not true. There might be some some positive or negative cash flows from that. Earnings before taxes, and then finally net income. They are net income profitable. I'm saying, hey, even combined, conservative estimate, they should be net income profitable, which is fantastic. Across the board, and those profits should expand as we move forward towards 2027. 2027, I'm saying we cross $1 billion of actual bottom line net profit, which is fantastic. What I did here is I did a present value of the current cash flows in these next 5 years. Also included a terminal value on there too, discount terminal value back to present day. And that combined equals the enterprise value. So I took my enterprise value, added assumed cash, in the future, also less debt in the future. I'm saying an equity value of $27 billion. Shares outstanding, 175 million shares. So that includes basically the Zynga deal share dilution as well as stock comp dilution in the future as well too. I'm saying today the share price is worth 157.48, which again is below the actual current share price. So I think there is actual some upside here potentially too. The biggest problem you're going to have in the near future, but it's just summer time frame, it's just macroeconomic trends. I mean, everything's getting killed right now, whereas, hey, short term, until that basically the Fed actually reverse pivots kind of off the tightening cycle they're in right now, this will keep getting hit pretty hard though too. But I think as it recovers, this is where I see kind of my neutral rate right here. That 150 mark should be kind of the baseline, that first target you're going to have potentially before it makes another run to 200 plus mark. But at least I say in the near future, assuming this goes well, this dollar value makes sense for me right now. Just a caveat off that, so there is one major risk factor I really see, and that's really the pipelines of both these companies. So Take-Two Interactive's pipeline, again, is much healthier than Zynga's overall. So, I mean, it's kind of like, your brand name titles you're going to have there. So they're going to have major kind of flops across the industry. So you have Grand Theft Auto coming to mobile. You have Kerbal Space Program 2, for example. Kind of these core gaming platforms they're going to have, which are going to be successful. We kind of already know that. The question we're really going to have to ask is how much they can go up, revenue-wise, how much actually can generate, etc. What really has me worried though overall is actually Zynga's actual basically their game pipeline itself. I mean, Zynga, because they play in kind of that business gaming casual space where it's very low barriers to entry. The games are kind of dumb in a way, and a little bit too. Is the problem there is, I mean, if they have a couple flops in a row, I mean, it could be very, very bad for them. Where basically they're burning cash but not receiving revenue kind of to make up for that cash. It's almost like venture capital in a way where you have 10 games overall. 7 of them are marginally successful. Maybe you break even. 2 are probably medium successful, or you make a little bit of profit there and it's pretty successful. You might have one where it's like a Farmville, where it's just a standout success, and all of a sudden it just basically pays for all the other losers out there, and you make a massive profit on the back end. Really, my big fear is I have personally is these gaming platforms might get, it might be an inflection point where it's just not as popular in general, even with mobile gaming platforms, maybe there's too many ads, maybe there's too many generics out there, maybe people just don't enjoy them as much. Especially competitive pressures like, looking at like TikTok, for example. I mean, taking eyeballs away from your phone or on your phone to other applications out there, whether it's Meta or anybody else out there. I mean, this is a negative, basically overall space for them potentially. And it can get very dangerous very fast for them also. And if gaming becomes boring, people don't enjoy it. Let's say, older generations are playing these games, don't enjoy them anymore, stop playing them, stop paying for them, etc. And all of a sudden you basically have a dying kind of the mobile gaming platform as we know it, as new forms of, entertainment or new forms of game come on board potentially and take over this entire platform, including like AR, VR, for example, too. So that's my big fear I have, where, I think short term, it's going to be fine. Long term, though, that's kind of my big fear I have potentially of Zynga itself. Hey, but that's the Take-Two Interactive and Zynga kind of merger in a nutshell, as well as the stock valuation for the combined businesses overall. But yeah, if you're an investor or thinking about investing in Take-Two, be sure to drop a comment down below. Be sure to sub to the channel for content just like this. I do various valuations of various companies. If you have any ideas, drop that in the comments as well too. But yeah, that's the exchange.